2017 to 2019 was a particularly strong period for the US economy. President Trump's tax cuts and the increase in government spending agreed by both parties brought momentum and confidence to the economy. Annual GDP growth averaged 2.5% over the 3 calendar years, a rate materially above potential growth, which we put at 1.75%. While during 2017 and 2018, growth in private demand was broad-based across the consumer and business sectors, firms' willingness to invest in and to expand capacity evaporated in 2019 as trade tensions escalated and were then sustained. To give context, in 2017 and 2018, business investment grew by close to 6%. In 2019, however, investment was broadly flat. It is important to note here that the sector's loss of momentum has been enduring. A broad-based contraction in business investment was seen over the 9 months to December 2019, and leading indicators point to further weakness. Above-trend growth was then only able to be sustained in 2019 because of a temporary increase in federal government spending growth, and much more importantly, due to continued strength in household demand. Of the 2.3% growth in GDP the US experienced in 2019, household consumption contributed 1.8 percentage points. As we look ahead, the health of the consumer is therefore paramount. From the December quarter GDP detail, it is clear consumption is coming under pressure. From a peak of 3.4% at September 2018, annual growth has since slowed to 2.6%. Note, this has been at a time of record low unemployment and sustained above average confidence in the US economy amongst households. What then has led to this deceleration, and is it likely to persist? Because consumer confidence is held at an above average level, we do not believe trade tensions have driven the result. Instead, it has primarily been due to a loss of momentum in wage and employment growth. Despite the US labour market having very little slack remaining, annual hourly earnings growth slowed from 3.4% in February 2019 to 2.9% in December. Growth in non-wage benefits paid to workers also slowed over the year according to the Employment Cost Index, accentuating the loss of momentum in total household income growth. While it is difficult to believe that wage gains will fall sharply from here, given the limited availability of workers, there is also no justification to believe a wage acceleration is imminent. If, as we expect, employment growth continues to slow back towards population growth in 2020, then the absence of an offsetting wage acceleration will mean total household income growth will continue to fade. This narrative is the basis for our view that the near 2% annualised consumption growth of the most recent quarter will be sustained through 2020. For as long as business investment remains weak, this will see GDP growth below trend. More than a decade into this expansion, and given global risks, this is not a development that the FOMC can remain unresponsive to, particularly as below-target inflation shows further signs of becoming entrenched. Hence, we look for the FOMC to cut 3 times in 2020, beginning in June. Our base expectation is that the stimulus will be able to stabilise US growth at trend in 2021. That will be a robust outcome, all things considered, but one well below the performance of the past 3 years. We'll see you next week.